Here are a few tips on saving some tax money by putting your money into your savings accounts. So we will take a look at the few savings accounts and how it will reduce your tax contributions, and you can come out as a winner with some savings and also save some money into your tax account. So my name is Sayed, so let's get started with this video. So we need to understand first what are the tax brackets, so and where you fall into the tax bracket. For example, if you earn up to $9,950 as a single, you will pay 10% up to this amount. So what does this mean, that tax brackets? So every time somebody makes some money, if they make 50,000, so they might be paying on first 10,000 as a single, 9,950, and remaining money after that up to 40,000 they're paying up to 12%. This is only federal tax rate. If we include state tax, for example, if you have 9% state tax, or there are different brackets just like that we have for federal, so you can calculate, and as you make more money you are going into the higher tax bracket, meaning you will pay more taxes. So in this example you can see, if you make less, you pay less taxes. But if you make, for example, $40,000 to $86,000 as a single, your tax rate is 22%, and not including your state tax could be 8 or 9%. So if we take a look at married filing jointly, up to 19,000, or we can round it up to 20,000 for example, just to understand, you pay 10%, and after 20,000 to 80,000, 81,000, you pay 12%. But anything above 81,000 you are paying 22%. And by the way, these brackets get updated every year. You want to check on IRS website. And so this is married filing jointly, and also there are different brackets you can see, but for the single and married filing jointly, you can see these are the brackets. If you are falling into 22% or 24% or 32%, you are paying very high tax rate on your yearly taxes. So how can you reduce your bracket? So in this video we will cover some of those tips. So if you are a salary employee, you will get 401k plan. You can also open your private IRA account, and from your employer also you can look into HSA account. So with these types of account, you can contribute money, and those are savings account that you can contribute and save money for your retirements. So these are retirement funds, and it will lower your tax bracket. And you can also contribute into pre-tax and after tax. So there are we will take a look at those accounts in detail. But if you put some money into the after tax account, so there is no tax benefit. But if you put into Roth 401k account, you will save some tax. You would not save any tax right now. You pay tax on it. You will be paying up to, for example, you are making more than for example, married filing jointly, more than $80,000 combined, and up to 172. So that is 22% your bracket for federal bracket. But on the tax growth on that amount is tax free. So if you put some money now and you're retiring in 30 years, so wherever you invest this money and that is growing, you don't have to pay tax on it. So that is a benefit. But we will take a look at it in detail how it is working out. So for example, how much you're paying taxes. For example, let's take a look at it, filing as married and filing as single. So let's assume that your pay is 150k per year, just for example. So you are paying federal income tax, you're paying state income tax. This is example for California. So your tax rates are added up here, and you can see Social Security, Medicare. Those are different taxes are accumulate in your pay, and end of the year you can see you are getting paid up to 71.77%, meaning take home money would be 107. And then rest of the money is going into taxes. And let's take a look at the example of, if you are single, you are paying up to 27% you can see as compared to merit, so this tax bracket went up. And also take home salary would be less, 64.89%, almost close to 40% taxes that you are paying in that. So that's how the taxes are. But if you can contribute some money into pre-tax account, so you will be lowering your brackets and you will lower your tax liability, and you will get more tax returns, or you would not pay tax on the additional amount. So let's take a look at it, how it works. So 401k have two types of account, regular 401k and Roth 401k. With regular 401k account, it is pre-tax, meaning if you put $10,000 in a year, you don't pay any tax on $10,000. So $10,000, if it is falling into the bracket of 22%, you save 22% tax on that. Not only for that, you also save on your state tax as well. And so 401k, and then you don't pay tax upfront, so you save money. And also when you take money out, you pay tax on that. So anytime you put some money into that, and if it is growing, and by the retirement age you take some money out, you pay tax on that. So 401ks are usually offered by company, and the good news is company offer, many times they offer match contribution, meaning if you put sometimes they offer up to 3% or 5% or 6%. So for example, your company says if you put 3% of your salary, they will match 3%. So if it is your salary is 100k and you put $3,000 in your 401k, your company will put $3,000 additionally for free for you in your savings account. So that is a free money you don't want to miss out on, 401k. Also, sometimes you can see Roth is not offered, sometimes it is offered. You want to take a look into that and see if you want to contribute into that or not. So retirement age is 59 and a half. If you want to take some money out of 401k, you can, but you have to pay penalty and before 59 and a half. And so that is the age limit you can check on IRS website as well. So contributing into 401k, you can avoid some taxes now. If you are in higher bracket, you can come down to the lower bracket, and so that is a good place to start off putting some money and take some your free money from your employer. So let's take a look at the IRA account. You can addition to your 401k, you can also open IRA account. IRA is just like 401k. The IRA have two types of account, meaning you can have IRA pre-tax and Roth IRA. Every time you see Roth, meaning that you pay tax and then you contribute afterward. So in traditional IRA, there's a limit of $6,000 in 2021 or 2020. You want to check on the IRS website what is the contribution limit, and also there is a salary cap that how much you make and how much you can contribute. So but for the merit filing jointly, I think the limit is 196k, 200k or close to 200k, something like that. So with that, if you put some money into your IRA, Roth, traditional IRA, you save tax on $6,000, and also you can lower your bracket into lower tax bracket where you are saving 22% or 24% or 34%. So that is a good place to look into where you can contribute. By the way, in 401k account, the maximum amount you can contribute in a year with your company is around $19,500, close to $20,000. Take for example, in a 1 year you contribute $19,500 and your employer match $5,000 or $6,000. That's how much you will have in your 401k. And when you open your 401k, it would be open with your bank or some financial institutions where you can select where you would like to put your fund into, and that funds also grow with that stock option or the financial investment option, that portfolio you can select, and that money will also grow with that. So That is just additional information I would like to add on. So Roth IRA is a little bit different, but very similar to 401k. You open your Roth IRA out of your employer account, and that is a separate account you can open up, and you can buy stocks with that, you can buy bonds with that, you can buy CDs with that. There are different options available for anyone to look into that, but for bonds you can look into that and buy stocks. So anytime you make a trade in that, there is no tax consequences. So meaning if you buy and sell your stocks, that is fine. So that is a good benefit for that. Also retirement age is the same, and also there is an early withdrawal. But with the Roth 401k, you can withdraw after 5 years depending on the situation. You want to check onto this, but because you in Roth you already paid tax, so there is a limit that you can take money out after some less time. And also the tax growth on that, if you buy some stocks in Roth IRA, is tax free. So traditional IRA also, but the thing is that if you contribute into Roth, you might be in the higher bracket, and if you contribute into the traditional IRA, there might be you are going into higher bracket into the lower bracket. So we will take a look at it, and we will mix and match. How can we take a look at it? We will discuss this in detail in further down into the video. So let's take a look at HSA account, health saving account. What is that? You can contribute up to 7,100 as a family, or per person I think is 3,500. So what happened is, when you contribute into this account, that is also have to be offered from your employer where you work. And when you contribute into HSA account, you don't pay tax on this amount. So for example, if you are single, you contribute 3,500. That money you don't pay tax on it, and also that money don't go away, and that will roll over. Even if you leave the company, this is your money, and the account will be stay open, and anytime you have medical expense, you can take money out of that. So but let's take a look at it, how we can save some money with that. So for example, you put money tax free, and if you take money out with your tax bill, you avoid tax twice. So that is a double benefit of putting this money onto that. Also, you can open your HSA investment account and transfer. If for example, if you put 3,500 and you only use 500 and you have 3,000 for this year, you can transfer into another HSA investment account where you can buy stocks and have growth of your HSA account. And so for example, if you put your money into a stock, and then it also grow tax free. For example, you buy $3,000 worth of stocks, they went up to $4,000, and when you have any medical bill, you use all of this money with your medical bill, you take this money out and you have tax free growth. So there's like triple benefit of tax savings on with this HSA account. So a lot of people don't take their money out, they only put this money into HSA, contribute, and put this into the investment account and buy a stock and have it tax-free growth, because they save tax on before they take the money out, and after they put it into the investment account. And by the time they go into the retirement age, they have a lot of medical receipts saved, and they use it, and every time they want to take money out, they use the receipt. You can put your receipts up to 20 years or 30 years or however long you have it, and every time you use it, you save your tax money onto that. So that is one of the good tool. So if you're filing jointly as a married, you have 7,100 limit into this, but there's a requirement of putting money into that. You have to have a higher deductible plan, medical plan from your employer. So you probably, if you're on PPO, you don't qualify. So that is another option. It's on a requirement that you need to fulfill. So let's take a look at it, how you can have some benefits with this three accounts that we were discussing, 401k, IRA, and HSA. So let's take a look at example. So if you are making 150k per year, your standard deduction is 24,000. I'm just rounding it up. I'm not sure if it is 24,500 or less or something like that, but this is just like, I know this is around that. So taxable income is $126,000, and your federal bracket you're falling into for the amount is 44,949. So taxes on this amount would be 9,888. So that's how much you're paying on higher bracket, on 22% bracket, and the previous brackets would be less. But if you have used savings accounts, let's take a look at it. Your salary 150k, same deduction is same. 401k you contributed up to 19,500. You put an IRA maximum amount of 6,000. If you are filing married jointly, you can also your spouse can contribute $12,000. I did not put this in there, so that would be another amount you can add. HSA $7,100. So your 22% bracket. So in taxable income is 93,000. 22 bracket is 12,000. So if I add 6,000 into that, that would be going into the half of this. So, but for now, taxable income is 12,000, and you are paying 2,717 in taxes. So let's take a look at it. So taxable bracket for 22% for without any savings account is 44,000. With this 401k, IRA and HSA, your taxable income is 12,000. So is reduced a lot, and so because of that you pay less tax of 2,717, and you would save up to $7,171. So if you only use only these three options and you max out on your savings, you will have this extra money in your tax return, and also you will have money into your savings account. So these tools you can use into your savings account if you use that. So let's take a look at it. Discuss about Roth after tax money. So what is a pro? It is a tax-free growth. You don't pay any taxes of your money grow if you put some money into your Roth 401k or Roth IRA. So you save on higher tax rate in the future. That is a discussion point I have seen many times. But the con is, for example, if you have regular 401k and regular IRA, you might be, so con is you might be paying higher tax bracket now, because if you're going for 24% bracket, that you are paying higher tax, and if you retire and you make less than $80,000, you take money out less, so you are going into 12%. So you maybe want to think about it, that if you put into regular 401k and take some money, don't pay tax now, and when you retire, when you pay tax, it would be lower rate no matter what. So that is another tax strategy you can use, and you would be losing on additional money by paying taxes that you would not get bigger tax refund if you're putting in after tax money, and also in your future your tax bracket might be lower. So that is it. Also, if people who have a business, they can also have some tax benefits by having a business. That is another option. So what are your strategies that you are using for tax savings? Please put them in the comments and let me know, and ask questions in the comment. And this video is for entertainment and educational purposes only. That is not financial or any kind of tax advice or anything. This is just a random guy on YouTube. Thank you very much for watching, and have a good one.